Good afternoon, everyone, and thank you so much for joining today's webinar on Employee Retention Tax Credit. My name is Camille Shaw, and I am the Project Director for our Coronavirus Relief Project in South Carolina, which is operated by DETSA Inc. Before we begin, let me give you a quick overview of our project. The Coronavirus Relief Project in South Carolina is funded by the U.S. Department of Commerce, Minority Business Development Agency. We work with minority businesses throughout the state to help them scale up, build capacity, and grow. That is why we made this effort today to keep the small business community informed of business opportunities that may benefit your business. Today, we would like to share information regarding the federal stimulus funding that your business may qualify for. The Employee Retention Tax Credit is not a well-known program, but it offers tax credits to businesses who retained employees during the pandemic. Mike Vanoy is the Vice President of Marketing at Assure, which is a national payroll and HR company. When federal laws change, allowing small businesses to retroactively apply for the credit, Mike's team developed a program to help businesses apply for stimulus funding. Thank you again for joining the webinar. We hope that you will receive a wonderful surprise of the tax credits eligible for your business. At this time, I will turn the program over to Mike so that he can tell us about the Employee Retention Tax Credit. Thank you.
Thanks for the introduction, Camille, and welcome everybody for joining us today. So I'm really excited about this topic. I think probably as the pandemic hit, most of us heard all about PPP loans, right? That as we'll talk in a minute, there was tons of stimulus money available for small businesses. The process relatively was easy to get, but it kind of overshadowed this really massive program around ERTC. I consider ERTC to probably be the second largest business stimulus program in U.S. history. PPP was clearly number one. The U.S. government stuck more stimulus dollars into the economy, whether it was stimulus checks directly to families or into businesses through the CARES Act. But for so many reasons, ERTC has been relatively unknown. So what is it? It is a tax credit, plain and simple. So unlike PPP, where you applied for a loan, you got the loan, and as long as those dollars were used in a way that they were intended, the loan was forgiven, right? But ERTC is literally a tax credit, right? So all you have to do is apply for an amended return. We'll get that in a second, but it's a 941 is the quarterly employer tax return. A 941X is an amended return. You file the 941X, the amended return, retroactively, and you literally just get your tax credit. Either you could apply it to future quarters and not have to pay the employer tax bill, or you check a box and you get a check back from the government for that amount. So it's a really, really big deal. I would highly encourage you. My hope that in today's conversation, I know we're going to talk for about 20 minutes and we're going to take questions. I hope everybody gets value from this, whether we ever talk again, whether you ever talk to Assure and do business. I would highly encourage you, this is not self-serving, hop on our website, assuresoftware.com/ERTC, and it explains all the details of what I'm going to talk through today, but maybe more importantly, there's an ebook about the employee retention tax credit. It's on the right side of the screen here that really unpacks all the details and includes workflows and kind of decision trees that can help you navigate to see, do you qualify, and if you qualify, for how much. So let's take a step back in history. So why is it that ERTC got lost in the noise? So you go back to January of 2020, and all of a sudden we start hearing about this virus, right? And things accelerated quickly, right? It was March 27th, all of a sudden, the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. It's a mouthful. So you probably heard of CARES, and CARES had a lot of things in it. Overwhelmingly, all the focus, and forgive the silly graphic with the flashing lights, but that's how it kind of was. It was all about PPP. It was a mad rush to get your PPP loan, and for good reason. Not only was it more money available in PPP, and it was relatively easier to get that money, it was an either or decision. You couldn't apply for employee retention tax credit, the ERTC, and PPP. You had to choose one or the other. So it was an obvious choice which you would make. Something really important happened December 27th of 2000. That was the CAA, the Consolidated Appropriations Act. And in that act, that was the outgoing Trump administration. And in that act, something really important happened, that new legislation basically said you could retroactively go back into 2020. Even if you took a PPP loan, you could also apply for the ERTC credit. But in that same bill, it introduced PPP second draw. So once again, PPP sucks all the oxygen out of the room, and that's where all the news, that's where all the focus, that's where all the energy was. And by the time people applied for their PPP loans in January, February, spent the money, got their checks, spent that money in Q1, Q2, ERTC kind of became this forgotten thing in the back half of 2021. And then with the American Rescue Plan Act, it extended this into Q2, 3, and 4, and made this an even bigger deal. But there was so much in that Rescue Plan Act that it didn't have the same, I'd say, newsworthiness that PPP did. So to me, this is the greatest untold story in business. And I want to walk you through some of the specifics about what it is, how you qualify, how much you could qualify for, take you through a use case, and then what would be the next steps, whether you ever talk to us again or you want to do this on your own or with your own CPA, how you could then apply for these credits. So this slide, I'm going to park here for a little bit. This is a bit of an eye chart. And you can hop on the website, you'll see the same thing, but I want to take you through the rows and columns. So the columns first. So I got Coronavirus Aid Relief and Economic Security Act. That's CARES, right? I'm going to talk through the ramifications of CARES. The next one is the Consolidated Appropriations Act. The next one is ARPA, the American Rescue Plan Act. So first of all, PPP versus ERC. I'll take you through the rows now. So originally, when CARES passed, it was, you had a choice, either PPP money or ERTC money, but not both. And as we go to the next column, when the CAA passed, December 27th, it retroactively said, even if you took PPP money in 2000, you could still retroactively apply for ERC so long as you don't double dip. And I'll go into more details about what double dipping means. But at the highest level, if I had, say, $1 million worth of payroll in the qualifying period of 2020, and I took a $200,000 PPP loan, then I would have $800,000 that I'd be working with to try to apply for ERC credit. So I couldn't have the same payroll dollars being paid with two different types of stimulus. So as long as you carve out and you don't double dip and pay the same payroll periods from using both PPP and ERTC dollars, you can retroactively apply. It's huge. And then when ARPA passed in March under the Biden administration, March 11th in 2021, you can continue to do both, but it extended it for a quarter, but also extended the statute of limitations. And this is where this is really important today, because here we are, we're nearing the end of Q1 of 2022, right? In 2020, oh my gosh, it's been a blur for a couple of years, but it's starting to become history here. Forever, the statute of limitations to amend a tax return has been 3 years. So you got as an employer, you have a 941 quarterly employer tax return, right? Where you document how much tax you've taken out of your employees' paychecks, and you've withheld that, and then you're paying those taxes in the employer's portion as well, right? So if you were to make a mistake, or something needed to be changed, you could always amend a tax return. That's always been a thing. And you could do that for up to 3 years, right? Up to 3 years after that period. Well, ARPA extended this to 5 years, meaning if you wanted to amend a return from, let's say, Q3 of 2020, you got until Q3 of 2025 to do that. So I don't want to remove a sense of urgency here, but what I want everybody to understand is this is a This is amendment to a tax return. This isn't some special fund that exists, like PPP was a fund and the fund could run out, so there's a race against time. This is a credit on a tax return. So it's simply filing the amended tax return and then you get the money back. So it's not some fund that we're tapping into. In the statute of limitations and extended, so there's really no reason for any small business who has qualifying wages to not participate. All right, drop down a row to company size. When CARES first passed, this was really only meant for the smaller businesses, 100 employees or fewer. When the Consolidated Appropriations Act passed in December of 2000, you know, if you think back in March 27th when CARES passed, they're talking, you know, okay, we're going to be in these shutdowns for 2 weeks or 4 weeks. We're going to stamp this thing out and then get back to normal. I don't think Congress contemplated this is going to be at that point a year-long thing or a multi-year thing struggling through this, right? So when they did this, started with CARES, it was only for small businesses under 100 employees. Once the impact was really being felt, and we were still in December, at that point I don't think we even hit the peak for COVID cases. It was rising to at that time a peak. It got extended to any company less than 500 employees. There's some nuance there around employees. It doesn't matter if it's how many employees you have per location, it's how many employees you have for the entity. If you have multiple entities, there's controlling interest ramifications, but basically they just rose the bar. So companies under 500 employees could become eligible, and that didn't change when ARPA passed. For who qualifies, all along it's really two things. Number one is if there's a government disruption or there's a reduction of gross receipts. Now the test for gross receipts reduction, that just means total revenue or total sales. That changed from CARES to the CAA and then continued on with ARPA. But the government disruption did not. So my experience here is that most businesses who had a material impact on their revenue, so if I go back to the CARES Act, right? If your gross receipts, so let's say you forget whether you had to shut your business down or your hours were restricted, maybe you're a restaurant and you couldn't seat as many people because of social distancing, maybe you ran a gym and you had limited hours, maybe you were in a city that had a curfew, maybe you're to play a business that it was illegal to run a hair salon for a period of time. I mean, there's lots of ways the government could impact you. But even if you weren't one of those businesses, but just the overall economic impact of that period of time, if your gross receipts were down more than 15% year over year, you qualified, right? If you were a business that maybe your revenue didn't drop that much, maybe it didn't drop at all, but you were legitimately impacted, then you qualify. So when we went to the Consolidated Appropriations Act, it wasn't a 50% reduction, it was a 20% reduction year over year. So the bar got raised a little bit. So they raised the bar for size of companies from 100 employee companies to 500 employee companies, so more people could qualify. And they raised the bar from financial impact. So if it doesn't require your business to be kind of gutted and cut by 50% or more, it requires a reduction of 20%, which is still pretty big, but not as big, right? I think the place that I would point people to look for, and I really mean look for how you qualify, is in the government disruption area. We would never, ever guide anybody to look for loopholes. This is our taxpayer money that is funding this stuff. So, this is completely above board. We are not, I'm not a CPA, I'm not a lawyer. At the end of the day, you need to, with your CPA, you need to attest that your wages are in fact qualifying wages. But the place that I think most people overlook is the government disruption. And so our experience working with, we have 80,000 clients. We've had a few thousand clients that we've taken through the process and filed amended returns for ERC for. The biggest area where so many people think that they didn't qualify at first because, hey, I didn't have more than a 50% reduction in gross receipts in 2020, or my business was down 5%, not 20% in 2021. But if their business truly was impacted, it could be a curfew in your local neighborhood. It's not a federal mandate, right? All the shutdowns happened with, from within, cities and mayors and county health executives and states and governors, right? So depending on how you or part of your even supply chain or your customers was impacted, could certainly lead to a qualifying event. So I would encourage everybody listening today, if you think you didn't qualify before, there's the most, I would say, vagary in the law around because they can't list all of the super specific ways that do and don't qualify for government disruption. But if your local health executive in your county, for example, reduce the capacity of your space, you're a retailer and you used to be able to have 100 people in your space at a time, and you can only have 20 people in your space because of social distancing regulations. Validate with your CPA, but that's a qualifying event that you are disrupted by these regulations, right? So that's who qualifies. Credits available. In 2020, it gets a little tricky, so try to be as clear as I can. It's up to 50%. Excuse me, it is 50% of up to 10,000 in wages for an employee after March 12th. So remember, that's about when the pandemic hit, middle of March. So think about Q3, Q4, Q2, Q3, Q4. If I have an employee who I pay, say, $40,000 a year, that's about $10,000 per quarter, right? And so that $10,000 for Q2, Q3, and Q4, that's $30,000. So up to 50% of that would then be eligible. Up to 50% of the first 10,000 of that 30,000 would be eligible for credit. So 50% of 10,000, that's 5,000. So as long as you have full-time employees making enough money that they cross that $10,000 cap, you're essentially talking about $5,000 per employee as an ERTC credit for 2020. When you go to 2021, this is the bottom couple, bottom center and bottom right. It goes from 50% up to 70% of that same 10,000, but now it's quarterly instead of for all of the entire year. Meaning that same employee who I pay, $40,000 a year, so they make $10,000 a quarter. I could have up to 70% of that $10,000 in Q1, up to 70% of that 10,000 in Q2, up to 70% of that in Q3, right? So originally under the consolidated under ARPA, it was extended all the way through Q4 when the infrastructure bill passed in November of last year. It took away Q4. So basically, you're talking about 70% of $10,000 in wages for Q1, 2, and 3 of this year of 2021. So that's a lot to get your head around, but just let me kind of recap it to talk about order of magnitude, what's really at stake here. So up to $5,000 per employee in 2020, plus $21,000 per employee in 2021. Remember, it's up to $7,000 per quarter times 3 quarters, so $21,000. So if you didn't take any PPP money, so there's no double dipping, and your business was impacted in a qualifying way, you could be eligible for as much as $26,000 per employee. Okay, so if you're a 5-person company down below, it could be $130,000 in tax credits. If you're a 50-person company, you're going to be looking over $1 million. Now, I don't want to oversell it, so let's just take a look real quick at kind of this whole double dipping concept. So if we have a kind of a fictional scenario, which is probably not so fictional, probably pretty close to home for many people. Let's say you got a $100,000 PPP second draw loan, right? So the Consolidated Appropriations Act passes December 27th, and over Christmas and New Year's, you're kind of finding out, oh, here's this PPP round 2. You talk to your banker the first week of January, you apply for the loan. It's middle, late January, you're getting your PPP second draw loan, right? And let's say your PPP second draw is worth $100,000, okay? Let's also, in this scenario, say that you qualified for ERTC in Q1, Q2, and Q3 of 2021, okay? So if I take you through the rows down below, so let's say you had a $100,000 payroll in Q1. Well, up to 70% of that could be eligible, right, for ERTC. So 70% of 100,000 is 70,000. But let's say you got your $100,000 PPP loan. Let's say you spent 60,000 of that in January because you got your check in mid-January, in February and March. So you spent 60 of the $100,000. Well, 70,000 in eligible payroll minus 60,000 spent on PPP, funded from PPP, means a $10,000 credit, right? Same scenario for Q2, $100,000 payroll, so it's up to $70,000. But here, you only got 40,000 left of your $100,000 PPP loan. So 70,000 available minus the remaining 40,000 of your PPP loan, there's 30,000 credit. Now Q3, there's no PPP money left. You've already spent it, right? You spent all your $100,000 loan. So theoretically, all 70,000 of this would be available. So this would be a scenario where a company, they got their PPP loan and they still qualified for 10 plus 30 plus 70, $110,000 in ERTC credits. So that's a fictional scenario. Let me give you a couple examples of real life scenarios. So like I said, we've done this for a few thousand customers now, where one example in Columbia, South Carolina, a commercial cleaning company, they have 80 employees. They received PPP-1 in the retroactive for them. They did not have the diverse impact in 2021, so this is a 2020 credit. They end up getting $600,000 in credit. Now, 80 employees, pretty good sized firm, right? But still a heck of a lot of money. Another real life example may hit home closer to the smaller businesses, the smaller employers and entrepreneurs listening today. A restaurant in Charlotte. So just 12 employees. They received both PPP-1 and PPP-2, and as we know, restaurants got hit among the hardest during the pandemic. And even though they took PPP-1 and PPP second draw, they still got $30,000 in ERTC credit. So the money is real, and I grew up in an entrepreneurial home. I still am involved in businesses. My wife owns a business. I know how hard it can be to sometimes even make a payroll, and how important $30,000 would be. So no matter how small you are, couldn't encourage you enough to go down this path and try to see if you qualify. So how do you qualify? Well, it's reviewing the qualifying wages. So what are qualifying wages? Well, it's not you as an owner. It's no 1099s. It can't be family members. Remember, the whole purpose of this stimulus was to keep people in the payroll, right? So keep people getting paid. So it's W-2, full-time W-2s, no 1099s or family members. Then it's calculating the 50% up to 5,000, 70% up to 21,000 for 21. And then it's simply filing a 941X. That's the amended tax return. Okay, so you can do that yourself. You can have your accountant do that, your CPA. I'll say the only plug I would make for Assure was this is what we do, right? So because we're a payroll company, we have payroll data. We help to review the qualifying wages, calculate the credit amounts, and then file those amended returns on your behalf. So that's the explanation of the program. I think I might have gone about 5 minutes long on you, Camille. I did want to stop and see if there's anybody had questions about. I can answer questions about Assure if you like, but hopefully questions specifically about the ERTC program. So there is a chat capability here in the GoToWebinar user interface. And if you have questions, please ask away. And I see our first one here. Okay, does this mean, this is Diane, does this mean that if there has not been a decrease in revenue, then the business may be eligible? Or the situation comes to revenue reduction, government disruptions? Yeah, so the language the language says of the law says it's an or statement, not an and statement. It's not you've been disrupted and you've had a decrease in gross receipts. It's you've been disrupted or you've had a decline in gross receipts. So there are, I don't know, thousands of pages of Q&As on the minutia of this, Diane, and I'm not going to pretend that I'm a CPA and I'm not going to pretend that I'm a lawyer. But what I would tell you is the rules around government disruption. That's got to be a government disruption tied to the pandemic, but it's government disruption or the economic impact. They aren't tied together. Hopefully that answers your question. Next one. What is the cost for your services? You know what? I don't want to say that publicly. I think we would work that out. So there's gonna be an opportunity will pop up at the as we wrap this webinar for you to fill out a form. Just make a declaration if you'd like to be in contact. But I think our team is going to be working with the folks at DISA to make sure that I believe that they've worked out some discounted rates that are available for DISA Association. So. This is presentation with instructions on how available, download, review. So this has all been recorded. Anybody who registered for this event, even those who couldn't make it today, we're going to circulate the recorded version, but pretty much everything I've said and a whole bunch more is available on the website, assuresoftware.com/ERTC. There's lots of the web page, but I really encourage you guys to download that ebook, and there's tons of great information there. This is applicable for nonprofits as well. The answer is yes. There are there are certain qualifications around different types of nonprofits, though, around healthcare and around it's no federal employees, and I believe there's some restrictions on education. So. And Camille, that's all the questions that I see come in. Do you see any others or have any of your own?
I have no further questions, Mike.
Well, we couldn't have ended it more perfectly. I got 30 minutes past right on the dot. So if there's no other questions, Camille, thank you. So, oh, you know what? I see one last one coming in. Let's take it in here. This comes as a check, correct? Oh, this is really important. So, Brad, great question. It's worth going 2 minutes long. It's the IRS. It does come as a check. I have physically seen checks for small businesses who have applied. I also know that people who have applied, oh boy, call it March of 2021, still have not seen their check. You may have heard the backlog. So just what all of us went through during this pandemic, you know, a lot of federal employees had to go home and couldn't work. There's shutdowns. And so there's this gigantic wave of unopened and unprocessed mail with the IRS in every aspect that you can possibly imagine. So the backlog with the IRS is just huge. I can't say that I can even see any rhyme or reason to the sequencing. I've seen some really big checks come to people that they have them already, and I know there are some smaller checks to people who applied earlier and still don't have them. So just don't have insight into the IRS, but it is a tax credit. So you have a choice when you file the 941X. Either you can apply this to future quarters, meaning you don't have that federal tax bill, or it's not income tax, it's employer's tax, right? Or you can get a check. So I think the fastest that I know of anybody getting it is probably in the neighborhood of 6 to 9 months. I know people who've been waiting over a year, but we also do know just anecdotally, because we file taxes for 80,000 clients, that the backlog of the IRS continues to get better every single month. That they are in fact catching up, but it's a little bit of a black hole for us on timing. But yet the short answer is yes, it's a check. Thanks for the question, Brad. Camille, I'll ask you. I see more questions coming in. Do you want to you want me to keep taking these and we go long?
Yes, let's go a few more minutes.
Okay.
Thank-
All right. Does that mean you can qualify even if there's not been a decrease in revenue? My non-CPA answer to that question is yes. It's an either or. It's government disruption or decrease in gross receipts. Google it. You're going to find CPAs that will disagree with each other on this topic. At the end of the day, whether we file the 941X for you or your CPA does or you do it yourself, you'll have to attest that these are qualifying wages. I've personally spoken with many CPAs where I've seen CPAs on the conservative side of the spectrum say, oh, no, that doesn't qualify. And I've had in the exact same customer, exact same case, where attorneys have signed off, yes, maybe it was a complicated case because a lot of if-thens and a lot of ins and outs, but they do qualify. So my encouragement to you guys, we're in the business of sharing the best information we can, right? So we're not CPAs, we're not lawyers, I'll keep saying that. But you should be in the business of shopping for the answer you want. As long as you have a CPA or a tax attorney that will sign off that yes, you do qualify, then you should feel comfortable that you do. But no, a CPA's job is to kind of keep you out of away from audits, and that's a good thing. But if you think that you qualify because of a disruption in service, get a second opinion if you're getting told no up front. As long as there's business disruptions. Yeah, that's a follow-up from Rebecca. Have churches received credits? Morgan, I can't say off the top of my head. I believe so. I believe so. Obviously, churches is, concert venues, churches, anything where movie theaters, where people gather, were heavily impacted. I'm not. This isn't a legal claim, but I'll say yes. I believe so. And Rebecca said thank you. So I think that's the last one. All right, Camille. I think that's probably a good place to wrap it. Anything you'd want to say in conclusion?
Well, thank you, Mike, for sharing the information with us. And thanks to the businesses who've joined. We hope that you have a good experience with this and a positive outcome. Thank you so much.
Thanks, everyone. And thanks, Camille, for inviting us.